Hi, good day, welcome back. My name is Raymond Galor, Master of Management student at the University of Niagara Falls, Canada. I'm excited to have you join me for the second video on Fall 2024 Finance for Managers series. In my last video, we explored the first module, Introduction to Finance, and now we're diving into our second module, Introduction to Financial Statements and Financial Health. So let's get right into it. Let's start with a question. What do you think a company's financial statements can tell you about its overall health? Introduction to Financial Statements and Financial Health. Welcome to Module 2. In this module, we'll look at 3 important financial reports that show how much money a company has, how much it owes, how much it earns, and how it spends. By understanding these reports, we can see how healthy or strong a business is financially. By the end of this module, you'll be able to recognize 3 key financial reports, understand how they connect, and use simple methods to check how well a company is doing financially. Financial statements. Accounting is often called the language of business because it uses 4 key reports, income statement, balance sheet, statement of owner's equity, and statement of cash flows, to explain how a company is doing financially, sequence of financial statements completion. When making financial reports, we start with the income statement, then the statement of owner's equity, followed by the balance sheet, and finish with the cash flow statement. The income statement. The income statement shows how much money a company made and spent over a certain time. Building an income statement. To create an income statement, we check if sales are higher than expenses, which means the business made a profit, and breaking it down shows which parts of the business are making or losing money. Revenue. The first part of the income statement is revenue, which is the total amount of money a company made from selling its products or services before any costs are deducted. Revenue example. For example, Lightbridge Company made $378,000 in total sales last year, but after returns and discounts, their final sales were $360,000, and then the cost of making the products is subtracted to see how much profit they earn. Income from operations. In the next step, costs like rent, utilities, and wages are subtracted, which gives us the company's operating income, or profit from its main activities. Net income. Finally, we get to net income, which shows how much money the company actually made after paying all its expenses, like taxes and interest. Income statement to balance sheet connection. An important part of the income statement is the net income. It affects the owner's equity on the balance sheet, showing how much the owner has earned. The balance sheet. Unlike the income statement that shows how a company did over a period, the balance sheet gives a quick view of the company's financial situation at one specific moment. The accounting equation. The balance sheet follows a simple rule. What a company owns, assets, equals what it owes, liabilities, plus what the owners put in, equity. Assets. Assets are everything a company owns, and they are split into 2 categories. Current assets, which can be turned into cash quickly, and non-current assets, which are held for a longer time. Liabilities. Liabilities are the debts a company has to pay, and they are divided into 2 types. Current liabilities, which are due soon, and non-current liabilities, which are paid over a longer period, owner's equity. Owner's equity is the money that comes from the owner's investments in the company and the profits the company has made from its business activities. Balance sheet balancing. It's important to remember that the total amount of what a company owns, assets, will always be the same as the total amount it owes, liabilities, plus what the owners have invested, owner's equity, which is why we call it a balance sheet. What is depreciation? Depreciation is how we spread out the cost of a physical item like a machine over the time we expect to use it, and the main ways to do this are straight line, where we take off the same amount each year, and accelerated, where we take off more in the earlier years. Statement of retained earnings. The statement of retained earnings explains how the profits a company keeps after paying out dividends relate to both the income statement and the balance sheet. The statement of retained earnings explains how the income statement and balance sheet work together, starting with the income statement that tells us if the company made money or lost money. Then, at the end of a period, we sum up the temporary accounts for income and expenses and move that information to retained earnings, which shows the total profit or loss. The retained earnings account shows how much money a company has kept from its profits since it began, after taking out any money paid to its shareholders, and the profits from the income statement add to this total on the balance sheet, making retained earnings a part of what the owners own. The cash flow statement. The cash flow statement is like a map of a company's money. It shows where the money is coming in and going out. Cash flow dynamics. To see how a company spends and receives money, we need to check the cash flow statement, which can be made in two ways. The direct method, where we track every single cash transaction, and the indirect method, where we start with the company's profits and make changes for things that don't involve actual cash, like depreciation. Cash coming in and going out is divided into three parts: money from daily business activities, money spent or earned from buying or selling things like equipment, and money from loans or payments to investors. And we will create a cash flow statement using the indirect method by looking at each part one at a time. Operating activities. The operating activities part of the cash flow statement shows how a company's regular business activities affect its cash. It starts with the company's profit and then makes adjustments for things that don't involve cash, like depreciation. Investing activities. The operating activities part of the cash flow statement shows how a company spends money on things like buying other businesses or buying assets like land or equipment. Financing activities. The operating activities part of the cash flow statement shows how a company gets and spends money for its business. This includes paying dividends, selling stocks, and borrowing money, bringing it all together. To finish the cash flow statement, we add up the money from all three categories. This total should match the change in the company's cash from the beginning to the end of the period. We've covered a lot in this module. Consider how correct financial statements help businesses understand their money situation, make better management choices, and attract investors. In this module, we learned about the income statement, balance sheet, statement of retained earnings, and cash flow statement. So to answer our earlier question, what do you think a company's financial statements can tell you about its overall health? A company's financial statements can show you how much money it makes, how much it spends, what it owns, and what it owes. This information helps you understand if the company is doing well financially, or if it might be in trouble. In the world of business, numbers tell a story. Understanding that story can lead to smarter decisions and greater success. If you enjoyed this video, give it a thumbs up, subscribe to my channel, and leave a comment below with your thoughts or any constructive feedback. Your input will help me improve and bring more value in future videos. See you in the next video, where we'll dive into Module 3, Statistical Analysis in Finance. We'll explore on the methods and tools used in finance to make smart choices, manage risks, and improve investments for better returns. Stay tuned.